Welcome to
Boring.
But Effective.
Thanks everyone for joining us today. We have Billy Leung, the superstar from Global X. Welcome, Billy.
Thank you. Thanks for having me.
No dramas, no dramas. Thanks for coming on. Now, first of all, can you tell us what makes Global X the market-leading ETF investment solution for our clients?
Yeah, look, it's a good question. I hope everyone sort of knows us by now, but when we do talk about Global X, I think one thing that we really, I guess, are proud of and leverage on is obviously we're a global company. Obviously we have offices across US, Canada, Asia as well. So, we are a global company that we leverage on in terms of even product differentiation. We leverage on each other's research, which is something that is giving us a lot of strength, especially on the Australian side. But I think one of the key points to really note is that with that global scale, we also have that parent company, Murray Securities or Asset Management, which is one of the largest asset management security houses in Korea that really supports us. So I think with those two together, I think that's how we sort of get that edge and leverage in terms of good products, providing good quality research, and just generally great service.
That's terrific, Billy. Yeah, thanks for that. Yeah, you're certainly you're a powerhouse when it comes to the research, and your global reach is it's second to none. It's amazing. Now, moving on to something a little different. One of the things we hear a little bit as financial planners is a bit of a myth around ETFs and how they're all high risk and they're all speculative shares and all that sort of stuff. I mean, is that true? And do you have an example of whether there are actually the difference between high and low risk ETFs?
Yeah, yeah. So I think that the short answer is definitely no. I think ETFs is probably one of the, I guess, not one of the, but a possible potentially safe option for a lot of investors, especially in Australia right now. And I think it's a good question because we get this a lot, especially in Australia, because the ETF market in Australia is still, I would rather say, relatively nascent. And it is growing very, very rapidly. I mean, if you look at all the competitors in our field, we're growing our assets under management, our AUM, at over 40% per annum. So this is very, very quick growth. But I think one data or statistics that's interesting to observe is that if you look at potentially in the more developed investment markets such as US. Around 20% of the US, I guess, investment market, has ETFs, is traded by ETFs. But if you look at Australia in terms of the total assets under management, only less than sort of 10% ETFs. So I think ETFs is still a very small contribution of the entire investment market, which is, like you said, why people don't sort of see this or don't understand this. And going back to your original question is, ETFs, I would say relatively does have a safe option because it is highly regulated. As the name suggests, it is a exchange traded fund, which means that it's traded on an exchange, which, as you would know, that it's very highly regulated, whether it's the ASX exchange or whether it's the CBOE exchange. So there is that regulation oversight and also the regulatory, other department oversight that gives that, ETFs a very, very strong support. But more importantly, I think we're also getting a large range of available ETFs right now. And I think like you were alluding to, obviously there are ones which are relatively high risk. Obviously we've seen, leverage products, derivative-based ETFs, which are, I could say more complex and harder to understand and, less sort of suitable for maybe retail investors. But, when you go on the other end of the spectrum, we have very, simple products which, are indexed against, for example, the ASX 200. It's indexed or based on follows the S&P 500. These are very, very simple to understand, very direct. And I guess, very simple ETF products, which are, I would say, well suitable for many, many investors.
That's brilliant. Thank you for clearing that up, Billy. Yeah, you certainly there is some speculative ones out there that can really push out the variations in your risk and return models. But there's certainly some others where the longer term approach, like you said, the ASX 200. Short term, yeah, there might be some volatility, but you're certainly going to be okay over the long run. Righto. Now, further from that, what do you think is going to be the fundamental driving economic force over the next 5 years? And it's your turn to shine. By all means, this is general advice, but what Global X ETFs do you think are poised to take advantage of the benefit from the growth?
Yeah, no, thanks definitely for providing that disclaimer for us. Obviously everything is advice in nature, and look, it's just great for us to share a view. But to take something that one of my US counterparts always have said is that we believe that the future is innovation. We believe that the future is actually artificial intelligence, which is something that we look at very strongly and care strongly across the Global X and globally, and even our parent company, Murray Asset, really believes in. So one thing that one of my colleagues always says is that in the future there's only going to be two kinds of companies, ones that use AI and others that don't exist. So we really truly believe that AI is a structural force, not just for the 5 years, but multi-decade. And one sort of research that we have done is that we've looked at the past 200, 300 years in terms of major innovation periods and how much these innovations has actually impacted the global economy. So we looked at, for example, steam engine, internet, all of these has somewhat improved the global economy by about 15 to 30%. But if you look at artificial intelligence and assume that it started around 2022, it's only incrementally given us about 1% incremental growth in terms of globally. So I think, we're very early stages of what AI can do right now. And if you look at sort of, in the nearer term, what really needs us to build up that artificial intelligence force is definitely energy. And I think a lot of people don't see that need for energy and even infrastructure. And another, sorry to sort of give you these numbers, but if you look at, one of the key statistics saying that in the future, we actually need 8% increase every year in terms of data center infrastructure every year for the next 10 years. But right now, the build out is only 2% per annum, which means there's a huge mismatch of energy and energy infrastructure for AI in the next 10 years, which is why we believe that obviously we are very focused on our Global X Artificial Intelligence ETF, the GXAI, but we're also very supportive, or we're getting a lot of interest in our Global X Artificial Intelligence Infrastructure ETF, which is AINF. And these two sort of give you that element of, yes, there are people using AI, there are adopters, but also the infrastructure side is a very huge bottleneck.
Absolutely, it is, and then there's the powering of those sources as well that feeds into a few of the others. We're not necessarily doing it we're definitely not doing it in Australia with the nuclear power, but certainly overseas there's a lot of data centers popping up within a Bernie Quinlan torpedo, for want of a better term, of a nuclear reactor.
Yeah, you're right. I mean, if we look at Amazon, Google, at Meta, all they're building their new data centers right next to the so-called small modular reactors, which are the new kind of nuclear plants, which are much safer, smaller, more flexible. And the fact that when you look at US, they've opened up, or they've reopened their 3 Mile Island nuclear plant, which is incredible. I mean, if you consider that that was one of the biggest disasters in the US, the fact that they're willing to reopen that plant is something that's really significant in terms of the expected energy demand in the next few decades.
Well, it fixes the upgrade of infrastructure problem, doesn't it, Billy? If you just build right beside it, just put a cable straight there.
Exactly.
Yeah. Hey, Billy, thanks so much for your insights. That was terrific. Now, moving on to the next topic. Now, what's your favourite meal?
Okay. Yeah. Look, I think, if you ask any, Asian cultured, background person, they'll definitely say something about favorite meal being one thing that your mum makes. And definitely, the one that makes, my favorite meal is definitely my mum's dumplings, for sure. But for me, look, I'll never shy away from a good steak and a glass of whiskey.
Oh, there we go. That's very nice. Are you a medium rare man?
Oh, definitely medium rare. Definitely over 300 grams is something I look for.
Oh, sensational. Rightio. Now, last question, Billy. The steak and whiskey is on, and you've got a spare steak and whiskey.
Yeah.
For anyone in the world, living or deceased, who you would love to meet and have a steak and whiskey with. Who's your person?
Yeah, look, I mean, it might sound a little nerdy, but I do like investments, and this is someone that I've respected. And obviously, I come from a background where I've been a trader, high frequency trading. So there is this fund manager from Bluecrest called Michael Platt. And I do like him because obviously he's done well, had a good track record, but it's also what he believes in. And interestingly, one thing that he's said in one of his books is that he doesn't like the traditional analyst. He doesn't like the traditional analyst, which gives you the 12-month target price, talks about how great the stocks are, does all the modeling. He likes analysts, or he likes people who understand edge, who understand advantages. And this is really interesting. So in his book, he gave an example of one of his favorite analysts, which was someone that woke up on the Sunday morning, based in London, and who actually played poker against people in the US. And the reason he did that was because that was a time when the people in US would have a big night out. They'll be a little drunk and they'll be playing poker online. So he goes online at that
Yep.
time against people who are obviously well pocketed, deep pocketed, thinking they're great, but obviously not in great senses. So he was saying this analyst picks up, probably about, 3 to 5 grand every Sunday morning, and then, goes out with his kids and family. So I really like that story because, this shows that, investments not really just about, all these numbers and things. It's about understanding your edge and understanding where your advantages are. And look, I'd love to have like a whiskey with this person. I think it'll be great. Just having a chat with him.
That's fantastic. Just once you've had 3 or 4 whiskeys, don't play cards against him.
That's a good idea, David.
or the analyst. If the analyst is hanging around, don't go and play
Exactly.
cards against him. Hey, Billy, thanks so much for coming on. I really appreciate it. And look forward to catching up with you in the future.
Yeah, no, thanks for having me. It's a great chat.
But effective.